Good afternoon. This is the third lecture in the series on capital budgeting. It's really a step back to introduce you to a class of analytical techniques, and this class of techniques is called break-even analysis. Analysts, when they look at a company, are interested in the point at which pain, losses, become pleasure, gains, or pleasure gains become losses, pain, when they vary an important variable. They're interested in the break-even point. This break-even point is the point at which a company manager would be indifferent between doing an action and not doing an action. The analyst looks at a scenario with an unknown outcome. Then, based on a set of assumptions of future conditions, they identify a break-even point. Then they assess the assumption's robustness. Then finally, they give an opinion as to which side of that break-even point the company would be if the scenario were to come to pass. Actually, we've done break-even analysis over the last two lectures. NPV is calculating a break-even point. If we buy the project for its expected net present value, then we would expect to neither gain nor lose from project implementation. IRR. If the discount rate is equal to the internal rate of return, then implementing that project will bring neither loss nor gain. Payback. If the cost of capital is zero, then we would expect the company to break even once it reaches the payback date. Discounted payback. On a cash flow basis, we would expect to break even in net present value terms at the payback date. So all of these are break-even analyses in some form. And remember, when we did our goal seeking, we sent a dependent variable, NPV, equal to 0 by altering independent variables of interest. Break-even analysis then can mean different things to different people. But in general, when a financial analyst says he or she is doing break-even analysis, they are referring to one of two questions. One question would be, at what level of sales in a year would there be a break-even on an accounting basis? So that would be an accounting break-even calculation. Another question would be, at what level of sales in a year would there be break-even on a cash flow basis? So that is a cash flow break-even point. Break-even analysis is highly transparent and it's highly intuitive. It's transparent because the analyst only manipulates a few variables. It's intuitive because it looks not at a long time horizon, but only at 1 year. Managers tend to think in 1-year time spans. One can plan a year in advance, and after all, managers are human. They, like the other animals on this planet, are affected by the seasons. We're programmed that way. So a year is a natural period of time. The accountants use the year as their accounting period. So you're looking at an intuitive length of time, and you can explain your conclusions with just a few words. Earnings after tax, and we're talking about annual earnings after tax, are equal to the price of a product minus the variable costs for which one produces that product times the quantity of products produced minus the fixed costs of producing minus the depreciation expenses times 1 minus the tax rate to give us after-tax earnings. Now with break-even analysis, what we wish to do is set earnings after tax is equal to 0. So we have 0 is equal to this relationship. And we bring the tax term over here underneath the 0. Now when you divide 0 by anything, you still have 0. So we can rearrange the formula by bringing these terms to this side of the equation. Of course, they become positive, and by taking the P minus V and putting it in the denominator, and we're left with the break-even formula. The quantity for break-even is simply equal to the fixed costs, where the fixed costs include both the cash fixed costs and the non-cash fixed costs, divided by P minus V. P minus V is known as the contribution. because it is what each unit of sales contributes to paying for those fixed costs. So let's have a simple example. Let's let the price equal $120 per unit, and let's let V, the variable cost per unit, equal $60 per unit. So the contribution, which is equal to P minus V, is simply $60 per unit. Let's say that the fixed costs are equal to $25,000 per year, and let's say the depreciation is equal to $100,000 per year. Break even from an accounting point of view is equal to 2,083 units. Now, if you remember the Majestic Mulch and Compost Company, you'll realize that some of these assumptions are very familiar. If we change unit sales from 3,000 to our break-even of 2,083, we'll find that earnings after tax is minus $13. If we take it to the next highest unit of 2,084 units, we'll find that earnings after tax is $26. So you can see that the break-even point from an accounting point of view is between 2,083 and 2,084 units. So an important thing to remember in calculating accounting break-even is that the tax term falls out of the calculation. It falls out of the term because at earnings after tax is equal to 0, taxes are 0. In our quest for financial purity, we shouldn't lose sight of the fact that the accounting statements are the statements by which most managers live. Using accounting break-even gives a number in unit sales above which the company will be in the black and below which the company will be in the red. It gives the number of unit sales above which the project starts to contribute to corporate earnings if we're talking about a single project. A project that just breaks even from an accounting point of view clearly does not provide positive returns to equity. Cash flow break-even turns out to be a little more complicated than accounting break-even. You remember that cash flow can be defined in several different ways. The way we wish to define cash flow here is cash flows from operations before changes in working capital. This is cash flow from operations is equal to the price of a good minus the variable cost times the quantity minus the fixed costs minus depreciation after tax plus depreciation. Setting the cash flow equal to 0, 0 is equal to P minus V Q minus FC minus D, 1 minus the tax rate, D, bringing D to the other side of the equation, minus D is equal to this relationship, bringing 1 minus T to the denominator, bringing the fixed flows to the other side, and bringing the whole term over 1 minus T. Q is equal to FC plus D, 1 minus T minus D, P minus V, 1 minus T, we find that the break-even quantity from a cash flow point of view is equal to the fixed costs times 1 minus the tax rate minus the depreciation tax shield divided by the contribution times 1 minus the tax rate. It's not very intuitive, but let's work through the example again. Q, which is equal to the fixed costs, 1 minus the tax rate minus the depreciation tax shield divided by the contribution times 1 minus the tax rate. Q is equal to 25,000, the fixed costs, times 1 minus 0.34, the tax rate, minus the depreciation tax shield, $100,000, times 0.34 divided by the contribution times 1 minus the tax rate, giving us a final cash flow break-even quantity of minus 441.92 units. I've never seen a negative power mulching tool, but let's plug this into our spreadsheet and see what it tells us. Originally, our unit projected sales was 3,000. We'll change that to a negative 441.92, and we find that yes, operating cash flows before working capital have dropped to zero. So what's happening? Well, that negative 441.92 unit sales gives us earnings before tax of 151,515 negative earnings. So this is a loss. The loss generates negative taxes, that is to say a cash inflow. Add the two together and you get earnings after tax of a negative $100,000. Add back depreciation because depreciation is a non-cash charge, and you end up with a break-even operating cash flows before working capital. But remember the whole purpose of this break-even analysis. We're trying to do something simple. Negative units of production is not simple. Whenever you have the depreciation tax shield greater than the fixed cost times 1 minus t, you're going to get a mathematically reasonable number that makes no sense from a business perspective because the business quantity will be negative. Also, the idea that the tax man is going to give a depreciation tax rebate of dt is probably not the way most tax shields work in practice. So we should calculate operating cash flow break-even assuming that taxes are zero. Once we make the assumption that t is equal to 0, then things become a whole lot more simple. The dt term drops away. No more depreciation tax shield to worry about. This just becomes 1, so we end up with fixed costs in the numerator, and the 1 minus t in the denominator drops away too, so we're simply left with the quantity for cash flow break-even is just fixed costs divided by the contribution. So in our case, we have the fixed costs, which are equal to $25,000, and the contribution is equal to $60 per unit, and that gives us a total number of units, approximately 417 units. Plugging the 416.67 units into the projected unit sales, we can see that earnings before tax is exactly equal to depreciation, which would give us, in the absence of taxation, a operating cash flow break-even of 0. But thanks to the depreciation tax shield, we show an operating cash flow before working capital of $34,000. This is, of course, assuming that the government is happy to give us a cash rebate, or that someplace else in the firm we have the capacity to use those tax losses. So in the case of cash flow break-even, what started out as a complicated formula became something very simple. Cash flow break-even is simply equal to fixed costs divided by contribution. This shows the level of sales below which, on an operating cash flow basis before any changes in net working capital and tax flows, the project or the company would need new infusions of cash. Infusions of cash are extremely painful for a company. So this cash flow break-even gives something that's very, very useful. Break-even analysis is beautiful. It's beautiful because it's simple. You've all heard the acronym KISS. Keep it simple, stupid. That's what analysts tell each other. Net present value analysis can be very accurate, it can be very insightful, but break-even analysis, simple cash flow break-even analysis, simple accounting break-even analysis has the benefit of simplicity. Accounting and cash flow break-even analysis show levels of annual sales below which a new project makes no sense, and an existing business is clearly not viable, because it ignores differences in cash flows between years, and the time of value of money. It's much simpler than NPV. Although it's rough, it can reveal the truth about a project or a company in terms that can be understood quickly by any thinking business person.